Swayam Prabha. Digital India. Educated India.
Hello everyone. Today's topic is behavioral finance in Indian real estate decisions as part of the course Real Estate Finance and Investment Strategies. First, let's discuss the learning objectives of this course, this particular class. First, understand behavioral finance principles in Indian real estate context. Identify systematic biases affecting Indian property investors, analyze the psychological factors influencing real estate investment decisions, evaluate market anomalies in Indian property markets, and apply behavioral insights to improve investment decision making. So first, let's define behavioral finance. So let's start with the foundation. Behavioral finance represent a revolutionary shift from traditional financing theory that while classical finance assumes we are all perfectly rational calculating machines, behavioral finance recognizes that we are humans with limitations and emotions. So the core principles of bounded rationality is crucial here. Our brains have limited processing power. When faced with complex property investment decisions involving multiple variables such as location, pricing, finance, timing, future appreciation, we simply cannot analyze everything perfectly. So we take mental shortcuts. These shortcuts basically leads to the systematic biases, not random errors, but predictable patterns of deviation from pure rationality. The key word here is systematic. These biases occur consistently across people and situations. And then we have emotional decision making, which is particularly powerful in real estate because of the high stakes involved. A property purchase might represent 10 to 15 years of family savings. This emotional intensity amplifies psychological basis. We also rely heavily on heuristics, mental rules of thumb. Instead of conducting comprehensive market analysis, we might judge a property's value based on how it compares to the first property we saw, or what our neighborhoods paid for their home. The traditional efficient market theory assumes investors are rational and well informed. The behavioral reality is that we are human with cognitive limitations and emotional responses that significantly influences our decisions. And continuing with the previous class discussion where we discussed about the bubbles, economic bubbles, which have been continuously being made in historically we have seen many such bubbles in economy, whether we talk about the dot-com bubble or the 2007 subprime crisis. So basically there have been in past, recent past also, where we have seen such bubbles where it is clear that it was not rational to the way market was behaving. The kind of the price appreciation in stocks which was visible, or in subprime, the kind of lending that time what was taking place in US in um, real estate. So the kind of difference between the reality and what was there in real estate market or stock markets at that time was like, it is not possible to explain that with rational logic. There has to be some emotional reasons why we keep on indulging in such acts. And there has been this continuous this pattern of market bubbles or market cycles. So there has to be some emotional reason also, and that is where the behavioral finance come into picture, that it is not just the simple arithmetic or logic which dictates our decisions, but there is propensity of our emotions also playing a key role in such financial decisions. And when we talk about behavioral finance, so it will also touch the real estate decisions which we make, and more so because the kind of emotional bonding we generally have, specifically in India, we talk about residential real estate. So there is this lot of connection between the mental connection, the emotional connection which we make with our property, because of the value system and the whole cultural behavior also plays a key role here. So there definitely this is something which needs to be looked into, because that is what is many times dictating the decisions in real estate in India. So Indian real estate market characteristics. So now let's examine what makes the Indian real estate market behaviorally unique. So these characteristics create a perfect storm for psychological biases to flourish. First, the high transaction values. So in most Indian families, buying property represents the single largest financial decision they'll ever make. So when you are committing 15 to 20 years of income to one decision, the psychological pressure is immense. This pressure actually makes us more susceptible to emotional decision making, not less. Right? Then we have family decision making. So unlike Western markets where individuals or couples make property decisions, Indian property purchase typically involve parents, grandparents, spouses, and sometimes even extended family. So each stakeholder brings different preferences, risk tolerance, and biases to the table. So that is another thing, that in such important decisions involving years of saving, the family system which we have in India definitely plays a crucial role, that everyone has an opinion in the family about the purchase of real estate, and so family decision making is also definitely involved in it. And the cultural significance of property ownership in India cannot be overstated. Property isn't just investment, it's symbol of success, security, and social standing. So this emotional and social weight often overrides pure financial logic. And then we have limited market experience is crucial. Most Indians buy property only 1 to 2 times in their lifetime. So compare this to stock market investor who make multiple transactions and learn from mistakes. Property investor have fewer opportunities to learn and correct behavioral biases. Finally, the information asymmetrics are severe in Indian real estate. Complex regulation, fragmented data sources, and varying local practices mean buyers often make decisions with incomplete information, increasing reliance on mental shortcuts and the emotional factors. Then these characteristics increase emotional investments. When stakes are high, emotions run high, amplifying psychological biases. Then we have group decision complexities, mean multiple biases interact and sometimes compound. And then we have status driven purchasing, means social consideration often override financial logic. And inexperience effects means investors don't learn from past mistakes because they make so few transactions. So all these are your behavioral implications, and a lot of emotions we can clearly see is going into real estate transactions. Then we have market context and development pattern. So understand the evolution of Indian property markets, help explain the current behavioral pattern. Now each phase created different psychological association with real estate investment. So the 1990s liberalization opened property investment to middle class Indians for the first time. This creates a generation that associates property investment with newfound economic freedom and opportunity. Many current investors carry this optimistic bias from their first exposure to property markets. The 2000 IT boom created an unprecedented wealth, right, in urban centers, particularly among young professionals. This period established property investment as the default wealth building strategy to emerging middle class. The success stories from this era continued to influence investment psychology today. Then 2010 regulation, so particularly RERA implementation in 2014 increased market transparency, but also the complexity. And many investors struggle with the new regulatory environment, leading to increased reliance on intermediaries and susceptible to the influence. And then we have post 2020 digitalization has transformed property searches and analysis. Online platforms provide more information, but also create new biases such as over-reliance on online ratings or being influenced by the order in which properties appear in search result. So, looking at all this regional market dynamics, each major market has developed distinct behavioral patterns. Mumbai space constraints create a unique psychology where buyers accept premium pricing as inevitable. This scarcity mindset can lead to overpaying for marginal improvement in location. Then we have National Capital Region, focus on infrastructure development, drive speculative behavior. Investor often buy properties based on planned infrastructure that may be delayed or modified. Then we have Bangalore IT sector concentration, which influences rental investment patterns, with investors often overestimating rental demand, stability, and underestimating vacancy risk. And then we have Chennai and Hyderabad and Pune show similar technology hub behavioral pattern, with investment decisions heavily influenced by employment growth, expectations in the IT sector. So these are some examples of different areas that we can see. So basically, if we look at history, why it helps us in learning, because many times when we interact with general people, people around us from different ages, their decision or their opinion on real estate depends a lot on what they have seen at a particular period of time. So if somebody who has seen 90s liberalization era, they are very much overexcited about the land prices, often looking for land buying up option or something like that, because the idea is that they have seen the humongous appreciation of land prices during that era. So they still carry that mindset that investing in land is definitely profitable, and that is how they think. Then we have 2000 IT boom period, where a lot of people made money in this sector, or by investing in shares in this sector. So basically, that period also led to urban demand, property demand in those areas, specifically Bengaluru and other areas. So the generation which has seen that in front of their eyes when they were growing up, or during that time they were actually at the age of working age or something of that kind, they still have those notions in their mind. So with the changing time period, they still carry the same mindset. So a lot of people think the way they have seen the markets at those days. Then regional market dynamics, we have seen that whether it is in Mumbai, national capital region, or Bangalore or Pune, there are different trends which are there. So that kind of regional impact also plays a crucial role. So basically, these are not hard and fast numbers which are influencing these people. These are some cultural or some time based reasons which are impacting their decisions. And one way to look at it is that you can just say that these are emotions. But when so many people actually are thinking alike, then it impacts the prices also. So one way to look at it is that you understand them, and then whenever you are creating your models, you also keep this in mind, that qualitative aspect also play a crucial role apart from quantitative aspects in real estate decision making, because a lot is being done on the emotions. Then we talk about anchoring bias. So anchoring bias occurs when we rely too heavily on the first piece of information we encounter in property transaction. This first piece of information becomes a mental anchor that influence all subsequent judgments. So listing influence is enormous. When a property is listed at 1.2 crores, that figure becomes an anchor even if the property is worth only 1 crore. Buyer negotiate down from the anchor rather than up from the true value. Research shows the properties listed 10 to 15% above market value typically sell for 5 to 8% higher than properties with market appreciating the initial price. So it's not completely illogical. So if you can list your price higher, then you may reap benefits of it, because generally the negotiation will be based on the listing price which you have given. So that kind of understanding of this mechanism also helps us in taking the right decision. And then historical price reference create temporal anchors. So if a buyer knows a property sold for 80 lakhs 2 years ago, they anchor on that figure and adjust upwards rather than evaluating the current market condition independently. So this is one example which I gave earlier also, that during COVID, we saw that there was increase in work from home culture, which has continued till date. So if that is there is a person who saw market before COVID and after COVID, and they have an office building, so they will think that the time where in 2019 it was at the peak, and there was absolute demand for office space, and then after that there was this period of work from home. So they might not reconcile with this fact, and they will still keep that price in their mind. So this kind of historical price references also play a crucial role. Then broker valuation provided early in the process becomes anchor for buyer perception. Even when buyers obtain multiple opinions, the first professional estimate disproportionately influence their thinking. So whatever the first professional opinion they have taken, it plays a crucial role in the buyer's mind, and they keep it in their mind that was suggested to them by that expert, And even though the other experts, majority of the other experts after that have contrary opinion, they will still keep that price important in their mind. Then we have comparable property pricing creates spatial anchors. So, the first property viewed in an area sets expectation baseline for all subsequent properties, even when their first property isn't truly comparable. So, the first point becomes very important, that is whether in terms of the listing price, your historical price reference, your first broker valuation or first property you have seen. So, that kind of first property becomes very essential. Then we have market impact analysis. So, property listed 10 to 15% above market value typically sell for 5 to 8% higher, that we understand. So, these are some advantages we can explore through these biases we can very well understand that are there in the market, and that is how we should utilize them. So, if we talk about mitigation strategies, so conduct independent comparable property analysis before viewing properties or receiving broker quotes. Seek multiple professional valuation opinions and receive them simultaneously rather than sequentially. Also, develop a systematic market research methodology that evaluates property against objective criteria, and then use price range analysis rather than the point estimates to avoid fixating on specific anchor values. Then we move to loss aversion in property investment. So, loss aversion is perhaps the most emotionally powerful bias affecting property investors. The psychological pain of losing 1 lakh feels roughly twice as intense as the pleasure of gaining 1 lakh. This asymmetry creates profound distortion in investment behavior. So, losing 1 lakh is twice as intense as the pleasure of making 1 lakh. So, if you have lost 2 lakh, that will affect you more negatively if we consider the impact on us. So, losing is more impactful than gaining. So, that is one important reason for this loss aversion. So, Indian property market loss aversion manifests in several destructive ways. So, underwater property retention is extremely common. So, investor who purchase properties that have declined in value will hold on to them for years rather than realizing loss, even when better investment opportunities exist. They are essentially throwing good money after bad to avoid the psychological pain of admitting a loss. So, that is one big reason. Then second is sunk cost continuation drives investor to pour additional money into delayed or problematic projects. Once you have invested 50 lakhs in a project that's running behind schedule, loss aversion makes it psychologically difficult to walk away, even when the additional cost and delays make the investment unviable. So, because you have already invested a lot of money, you still keep on investing smaller amounts, thinking that the situation will reverse, even though there is no possibility of that. So, then we talk about overvaluation of owned assets is systematic. Homeowners consistently overestimate their property value by 15 to 25% compared to market assessments. This isn't just optimism, it's loss aversion, preventing them from mentally accepting that their property might be worth less than they paid. So, that is your overvaluation. Then we have risk seeking in loss domain is particularly dangerous. So, when investors are facing losses, they often increase speculation and take bigger risk trying to get even. This is the opposite of rational behavior and often compound losses. Then the market consequences. So, reduce market liquidity during downturn as sellers refuse to accept market clearing prices. Then price rigidity that prevents market from adjusting efficiently to new conditions. Then capital misallocation, resources remain locked in underperforming assets instead of flowing to better opportunities. Let's take one case. This particular case illustrates perfectly residential investor who purchased properties in 2017 and 2018 at peak price, demonstrated significantly longer holding period during 2019 to 2021, price corrections. Average time to sale increased by 18 months compared to historical patterns. These investors essentially kept their capital tapped in declining assets rather than accepting losses and redeploying capital more productively. So instead of selling and coming out, we saw that when there was a downturn, they waited longer for selling their assets just so they can go back, the prices can go back to the level which they paid. So basically, they could have booked their losses, moved their capital to some other property or some other other asset class and could have gained during that period. But instead of that, they kept on waiting, and if we compare the numbers, then we will find that maybe they were able to sell their property at the same price, but because of that time period loss, they have actually lost on the returns which they can get. So that kind of system is your loss aversion in property investment. Then overconfidence. So overestimation, believing performance exceeds actual results. Overplacement, thinking abilities surpass peer performance. And third, over-precision, excessive certainty in judgment accuracy. So these are three components of that. So let's take them one by one. So overconfidence is particularly dangerous in real estate because the high stakes and infrequent transaction means mistakes are costly and difficult to correct. Overconfidence manifests in three distinct ways. Overestimation involves believing your performance exceeds actual results. Property investors often remember their success vividly while forgetting or downplay their mistakes. Then overplacement, thinking your abilities surpass your peers. Many investors believe they have superior ability to identify emerging areas or time the market, even without evidence of past success. And then we have over-precision, involves excessive certainty in judgment accuracy. Investors often express high confidence in estimates that should have wide uncertainty ranges. So that kind of system, whether it is overestimating, overplacement and over-precision, are kind of overconfidence reflecting issues. Then in Indian market, overconfidence appears in several specific ways. So location selection confidence is widespread. Investors believe they can identify the next Gurgaon or next Whitefield based on limited analysis. The reality is that successful location timing requires sophisticated analysis of influence of infrastructure, employment patterns and regulatory factors that most individual investor cannot access or process effectively. Then we have market timing. Overconfidence leads to investor to believe that they can predict price movements with precision. They make statements like prices will rise 15 to 20% next year with unwarranted certainty. And then we have rental income projections are consistently over optimistic. Investor underestimate vacancy period and overestimate rent growth, leading to cash flow shortfall. Then we have construction timeline estimate shows systematic overconfidence. Investor consistently underestimate project completion delays, affecting both their financial planning and opportunity cost. The quantitative impact is measurable. Analysis of Bangalore IT corridor investment from 2015 to 2020 shows investor consistently overestimating rental yields by 15 to 25% and underestimated vacancy periods by 3 to 6 months. So, this overconfidence led to inadequate cash reserves and forced selling in some cases. So, these overconfidence which can reflect in this way can definitely impact the performance of the returns of which we can get from a property investment. Then we have confirmation bias and the information processing. So, confirmation bias involve seeking information that supports existing belief while avoiding the contradictory evidence. So, selective market research focusing on positive area, development news, professional opinion shopping, consulting advisor until receiving supportive views, or media consumption pattern reading only bullish property market analysis. And the fourth, socializing with similar minded investors. Now, these are some very lethal combinations if you have all of them. That is, when you have a notion in your mind and you want to basically read, talk and discuss only points which are supportive of that. So, you try to seek research which is in line with that thought which you have in your mind. You try to take professional opinion, or you can say that you keep on taking the professional opinion till you find the person who is thinking in line with what you think, and you trying to find media reports which are also supporting your thought process or your idea or your view on the market, and also you are interacting or making friends with those investors who are also thinking alike the way you are thinking about the real estate market. So, that kind of things can be your confirmation bias. Then decision quality impact. So, in incomplete risk assessment, over optimistic investment projections, delayed recognition of changing market conditions and missing alternative investment opportunities will be your decision quality impacts because of the confirmation bias. Then family decision making dynamics. So, we have multi-stakeholder property decisions. Indian property purchases typically involve multiple family members with varying objective and risk tolerance. So, you might have your mother who might not be very she might have a different risk related opinion. She might be very conservative in taking risk. Your father might be having different way to deal with risk. You might be having your own way, and similarly in your family other members might be thinking in different terms. So, this difference of opinion, this difference of attitudes, and this can be reversed in different families, but basically the idea is that everyone have their own way to think, assess risk, and when all of them sit together, then definitely they will impact the decision regarding the real estate. So, what will happen? Generational preference difference. So, traditional one versus modern location preference. So, you will find that the elders in the family might have different view in comparison to the young people, the kind of locations which they prefer. That preference you can understand with traditional and non-traditional values. Then risk tolerance variation, like we discussed, the older generation might have less risk taking propensity. And then timeline conflict. So, immediate needs versus long term investment perspective. So, that may be also there, that some in your family might have immediate needs and other might be thinking of long term. Then budget allocation disagreement also, that what percentage of finances we will be putting in. So, that kind of property investment versus other financial priorities. And then of course, behavioral implications, that compromise solutions. So, suboptimal choices satisfying multiple preferences. So, because of multiple preferences, you may not go for the best property, but instead of that you go with something which satisfy everyone. And then decision delays may take place because you have to take opinion of everyone and accordingly find the right real estate, and it will take time. And then risk dilution also, conservative bias from multiple stakeholder involvement. So, that can also be there. And then groupthink effects, so reduce critical analysis with family units, and critical analysis will take a setback and backseat, and the basic idea would be to take basically to ride emotions and take decision on the basis of emotions. Then social status and property investment. So status signaling through property, that is also something very, very important when property investment decisions are taken. Property ownership serves as viable wealth indicator in Indian society, influencing the investment decisions beyond financial considerations. So psychological drivers like conspicuous consumption, property purchases demonstrate social successes. Peer comparison, your friend has bought this level of house, whether their financial conditions are different from you, that sometimes doesn't matter. And psychological impacts, psychological effects or emotional needs then take over the logical needs. Then interpretational expectations, meeting family and community expectation. So that is there. Then professional image also, sometimes that you want to maintain your professional image and you have to have certain type of real estate or not. So that kind of, thing can also be dictating the decisions. And then investment distortions. So over investment in visible features which show off basically, or premature purchasing timing, buying before optimal financial capacity you have reached, you just want to prove something, to show something. And then some optimal asset allocation, investing too much into property even though there is a significant chunk of your income going towards that. So these kind of decision can also be impacted by social status. Then herd behavior. So herd behavior is because we follow what other people are doing. So you will see that IT corridors development, sequential investor, entry into technological employment areas, more and more people invested in IT corridor, hoping for, the demand to keep on rising. Maybe that will happen or not happen, but that is how we can see that, because everyone is doing that, so you have also done that. Then infrastructure led investment, so mass investment following metro rail announcements. Then suburban expansion patterns following successful early suburban development. So you are hoping as that happened in that area, so something similar will happen in this area also, though there might not be any such plan by the government. Then investment strategy herding, so buy to rent wave, so coordinated investment and rental property markets. So you are just not thinking that whether the rental yields will be remain like that or will go down or go up, you just following what others are doing. And then redevelopment speculation, that mass speculation in urban renewal areas. So you think that because redevelopment takes place, so you buy property just because you think that it will go for redevelopment, you might gain something out of it. And then NRI investment patterns can also be there, that non-resident Indian investment clustering in specific cities and focusing on that area. Some areas are specified areas demarcated as colonies or living spaces for NRIs, and they do come and buy properties in those areas or those townships or those gated communities. So that kind of definitely influence the NRI community also. Then you have market cycle amplification. So herd behavior amplifies both upward and downward price movements, creating boom bust cycles more severe than fundamental factors would suggest. So like I said initially, that the bubbles which are there in the market, they definitely indicate this, that it's not just numbers but emotions which play a crucial role in any financial market. Then we have professional influence networks. So here we can see that we have real estate intermediary impact. For example, we have social proof utilization, we have urgency creation, we have authority positioning, and we have consensus building. So there can be so many such points. So let's take them one by one. So we have social proof utilization, which is referencing successful client example, right? So property consultants will keep on referring to that one client or few clients who gained because of their advice. So they also try to remember themselves and want to show that, see, we had the successful clients example, so definitely this will happen with you also. And then urgency creation, so they may almost sometime tell you that there is a limited time available, and that will be used as a pressure tactic to sell something. And then authority positioning, that leveraging professional credibility, showing that because I am a professional, I know more than you. So that kind of authority positioning also sometimes can be used as influence mechanism. And then consensus building, that emphasizing popular investment choice is this, so this definitely must be the correct choice. So these kind of methods are also used by brokers, consultants, and financial advisors to sell their ideas to the real estate first time investors or infrequent investors. Then we have market consequences. So professional network can accelerate both positive and negative market trends by coordinating client investment pattern across similar demographic segments. Then we have Indian property market cycles. So this almost mirror the cycle other places also. So here you can see that you have behavioral cycle components, like we have growth phase 24 to 36 months. So fundamental drivers like economic growth, infrastructure development, demographic changes, all this is fundamental drivers which are acting in this phase. You are having economic growth, you are having infrastructure development, demographic is also improving. So all this is leading to growth in the market. And then we have psychology of investor, which is cautiously optimism, because you have maybe just come from downturn, you are cautiously optimistic, you are thinking rationally, clearly, and but you are little hesitant, but you are little optimistic also, seeing all this. So there is a mix of emotions. And price behavior this time will be steady, 8 to 15% annual appreciation. Then there will come a expansion phase where investment demand exceeds end user demand. Now people have started gathering the confidence and they have become more positive on the market. So media has also started amplification, positive coverage increase, market participation, and price started accelerating at 20 to 40% annual appreciation rate. So steadily earlier, and then now fast moving markets. Then there will come a peak phase where pure speculation will start. There will be affordability crisis. There will be complete mismatch between the prices and affordability of people, and there will be warning signs like extended inventory. The inventories keep on piling up. There is not much buying happening, but prices are not coming down. And then you will see that also the transactions have reduced in volume because of all this. And then sudden realization after that, that is during the correction phase, where reality assessment, fundamental value recognition, that yes, there is a lot of inventory, people will start realizing that they will have to bring down prices, or they have to be more, they have to start negotiating. They cannot keep the same rigid opinion which they had during peak phase. And then force selling, because some of them will have leverage, so they will start selling first, and then of course the other people will follow them. But initially the most leveraged investors will start exiting the positions, and then ultimately there will be price adjustment and gradual return to fundamental values. So this is how the property market cycle will take place. Then we have regional behavior patterns. We have discussed this earlier, that whether it is in Mumbai, National Capital Region, or some southern technology hub, you will find that there are different behavior patterns region wise. So for example, Mumbai, you will see that premium willingness due to land constraints, right? Because the land is so few far that you have to pay premium. So people will pay premium prices for little extra amenities. And then micro location sensitivity. So neighborhood level price variation will take place, that a little change will, prices will definitely start fluctuating. Commute cost integration, so transportation cost in investment calculation. So all this will, play out, that how far your office is and all that. So Mumbai metropolitan region, you will see this. In NCR, you will see that, policy sensitivity has high responsiveness, that what government is bringing in, what new project is coming in, and infrastructure speculation, that investment based on planned development. So all this will play crucial role there. And affordability migration, so sequential movement to peripheral areas will start taking place, that people will start moving from the core to the peripheral areas. So this kind of, movement will happen in National Capital Region. And then we have behavior will happen in National Capital Region. And then we have southern technology hubs, where IT growth is impacting the growth. So employment correlation, so strong linkage between IT growth and property demand, we will see there. Rental yield focus, basically investment oriented market participation, so that they can seek rent, they might be investing in that way. So this kind of, thing you will find in southern states, southern technology areas. And then you will see that quality premium, so willingness to pay for construction standards, because they understand that the premium real estate may fetch more rent. So that kind of thought process will work here. So these are your regional behavior patterns which you can see. Then we have market timing and behavioral factors. So you will see that in some seasons, especially the festive season, you will have premium like 3 to 7% higher transaction activity during October, December. So activity will increase. Tax year ending timing, so investment clustering in January to March period for the tax saving purposes. And then monsoon impact will also be there, that reduced activity during heavy monsoon rainfall period. So these are some predictable things which you can see about the behavior. And then economic event responses. So interest rate sensitivity, immediate demand response to monetary policy changes will take place, because we have understood that there are loan which are directly linked to the monetary policy of RBI. Then regulatory announcement, so strong reaction to policy modifications. And infrastructure completion, so anticipatory investment before project delivery. So before a particular government project or public project takes place, completion is there, just before that, you will, or even before that, there will be anticipatory investments. Then we have bias mitigation strategies. So individual investor approaches, so systematic decision framework. We will have multi-criteria analysis, structured evaluation of location, price, timing, and financial factors. So systematic, this multi-criteria analysis, these can help in mitigating the bias. Okay. So for example, instead of, having only one, you can use multi-criteria, structured evaluation, basically of location, price, timing, and financial factors. Then devil advocate process, so actively seek contrary information. Instead of looking for information which confirms your bias, you are looking for opinion which are opposite to what you think. So that kind of, tells you that what exactly is their opinion, that why they are thinking in contrary to what you are thinking. So when you have multiplicity of such opinions, you will be better able to take the right decision. Then cooling off periods, so mandatory delay between property viewing and purchasing decision. So once you see a property, not buying it immediately and thinking about it, taking some time is the prudent way. Then independent verification, so third party validation of key assumptions should be done. So third party opinion can be taken in such scenarios and it will reduce your bias. Then emotional regulation technique. So we have stress testing, analyzing worst case scenarios before investment, right? Sunk cost recognition, acknowledging and accepting past investment mistakes, and then moving on from it, instead of keep on investing more because you have already invested some amount in that particular thing. Then opportunity cost analysis, so comparing property investment alternative options. So instead of waiting for your price to come, you must remember that there is an opportunity cost attached with the time the time period for which you wait, you can recoup your investment and make more out of it by changing the property. That can also be done, or you can also go for other investment option. Then professional investment management. So committee based decision, reducing individual bias impacted through group evaluation. We have this professional investment you can also take, so that if group will evaluate, you will be better, your individual bias will be reduced. Then systematic screening processing, you can use standardized property evaluation criteria. They are available online also, so you can use them to reduce your bias. And performance attribution analysis, understand sources of investment return, and this way also you can reduce the bias. And then regular portfolio rebalancing, maintaining optimal asset allocation despite emotional attachment. So keep a rule that after a period you will rebalance your portfolio, and then you stick to your rule, and instead of using these emotional reasons, use logical reasons in rebalancing your portfolio. Then technology integration and decision support. So predictive analytics, using historical data to forecast price movement instead of your own biased opinion. Sentiment analysis, monitoring social media and news for market psychology indicators. So instead of your individual opinion, try to see what mass in the public opinion is there, because that will dictate the overall price movement of the properties. And then comparative market analysis, automated comparable property identification and valuation. So automate the comparable property identification and then accordingly value. That can also be a good way to reduce your bias. And then risk assessment models, the quantitative evaluation of investment risk, that can be done so that your own qualitative opinion is countered by the quantitative evaluation of the property. And then digital platform, online property platform, reduce the information asymmetries and enable more systematic investment analysis, potentially reducing the behavioral bias impact. That also you can keep updating yourself with online platform information. So in the conclusion, we have behavioral finance provides insights for understanding Indian real estate investment pattern. Systematic biases include anchoring, loss aversion, overconfidence, and confirmation bias significantly influence the individual and market level outcomes. Social factors, particularly family decision making dynamics and status consideration, create additional complexity in Indian property markets. We have to understand these behavioral finance points, these views, these points. Next time we take decision, we remember that these can impact our decision. Then we have also seen that herd behavior amplifies market cycle, creating periods of speculative excess followed by correction. We have also seen that effective bias mitigation requires systematic decision making processes, emotional regulation techniques, and technology assisted analysis. And professional investors and individual buyers who recognize account for behavioral factors demonstrate superior long-term investment performance. So behavioral finance, we saw what are the different things which are impacting the decisions. We also saw that how herd behavior is leading to speculation and bubble formation, and then how we can mitigate all this, that how we can mitigate the bias. We have seen those techniques also. So overall, we have to understand that the investment is not just pure numbers. There is lot of emotions involved. Sometimes you can utilize these emotions by understanding what is happening in market, keeping yourself updated that in which way people are thinking. But individually, when you are taking decision for your own property purchase, you should try to mitigate personal bias, and you should go for more and more such systematic approaches for investment. So that will be very, very helpful for you. So I hope this session has helped you in understanding that bias plays an important role in real estate investment. Thank you so much.